look is a peak in short-term interest rates or a steeper yield curve. And then ideally, I would like to see more attractive valuation, which is not necessarily what you want to have, because it means that the market should fall a little bit more. But definitely a steeper yield curve and a trough also in earning revisions as well. And we have seen a lot of negative news on revisions. So I think this is the preconditions that I want to see before turning more optimistic on stocks.
Luca, we went through that opening quote of yours, and we picked out the peak in nominal GDP, picked out the move into government bonds. Let's pick out that final piece of it. The US investors should diversify away from US stocks. Luca, to where and why away from the US?
Look, John, it's not going to be easy. And when we have a global recession and markets down, there are not many places where you can hide. I think I can mention one, though, Japan. Japan, you have an economy that is actually growing, interesting enough. There is no risk of inflation. Monetary policy is supportive, and you still have decent valuation, and obviously a cheap currency as well. So if I have to mention one, now probably the Japanese equity market is the most attractive for US investors.
Luca, are you comfortable with that over a long time horizon? What is the time horizon for that investment?
We're talking about 6 months to 12 months. I think if you go over that, I think the attraction, I think of the U.S. market is probably more significant. But over the next 6 to 12 months, I think for the U.S. it's going to be difficult. It's going to be difficult for Europe, and if you look at Asia, especially Japan.
Luca Paolini of Pictet. Luca, fantastic to catch up, sir. As always, the S&P 500 up by around about 0.6%. Talked about this energy move in the commodity market rallying off the back of this story around OPEC+. Energy names on the S&P right now of 3.98%, up almost 4%. That's a big story for us this morning. Coming up, Europe's energy crisis continuing to escalate.
We're at a very challenging moment, no? Because the war is entering a new phase, or so it seems. We also see that Nord Stream supply was cut 1st of September.
We'll get the latest on Europe and the latest on OPEC+ and a conversation about output cuts next.
We're at a very challenging moment, no? Because the war is entering a new phase, or so it seems. We also see that Nord Stream supply was cut 1st of September. The positive element here is that prices are not continuing to escalate as they did in past months when Putin was using the energy blackmail.
Brilliant conversation there with Spain's Deputy Prime Minister Nadia Calvino speaking to Bloomberg's Maria Tadeo. Getting some breaking news here stateside. Let's get to it. Here's Mike McKee.
Well, John, the Fed is trying to slow growth, but the first indicator of the month of October suggests there's still strength in manufacturing. The S&P Global PMI for manufacturing in the U.S. is at 52. That's up from 51.8 the prior month. The forecast was for no change, so a little bit stronger on the manufacturing side than we had anticipated. ISM manufacturing comes out at 10 o'clock, top of the hour, and that is also expected to register 52, which would be a decline in that index. We'll see. The world is struggling right now with manufacturing outside of the United States. We're pretty much the only country showing expansion. You look at the global slowdown in Europe today, all of the countries reporting in the 40s. Italy had a slight rise, but still below the 50 mark. And so we're looking at numbers that are just telling us recession is pretty much here on the European manufacturing side.
Mike McKee, what do you learn from the regional Fed indicators at the same time?
Well, the regional Feds have been telling different stories depending on what region you're in, but they have all kind of at least regrouped, I guess was the way you'd put it. They're not all falling anymore. They're not rising hugely, but it does show there's still some strength in manufacturing in these regional indexes, and it suggests that the Fed's work is not done on that side. We've been expecting manufacturing to slow in favor of services, but so far, manufacturing hangs in.
Mike McKee, thank you. Looking forward to the breakdown of the data in around about 13 minutes' time. Mike McKee and the team breaking down ISM in around about 13 minutes. Looking forward to that. Yields much lower this morning. We're down 15 basis points on a 10-year to 368. At the front end on twos, we're down about 15 basis points to 4.126%. In the equity market, a rally up by more than 1%. Leading the way, energy stocks up by 4.6. Energy in the commodity market rallying hard. OPEC Plus considering an output cut by more than 1 million barrels, the first of that size in more than 2 years. Energy Aspects and Reader Sense saying the following: OPEC Plus are very focused on stronger US interest rates and its impact on emerging market demand. Hence, they want to preempt any possible surpluses in the global market. Team coverage starts right now with Bloomberg's Maria Tadeo in Luxembourg alongside Will Kennedy in London. Will, first to you. Were you and the team surprised by this one from OPEC Plus and the team?
I think we were surprised that they suddenly switched it to an in-person meeting, which suggests that they're going to take significant policy action. And of course, a cut by 1 million barrels a day or more would be a significant policy action. But I think OPEC has been headed in this direction for a little while. They are clearly, as Van Meter said, concerned about the slowdown in the economy. They're concerned about the weakness in China's economy. And they felt that they needed to act and act soon before the market got away from them. So to an extent, but I think that the momentum to some sort of cut has been building.
Well, we're having the bets waged right now, whether this one goes on for 12 or 13 minutes or longer or shorter in person in Vienna. Is this going to be a long meeting?
I think it will be longer than the 12 to 13 minute meetings that we've been used to because, you know, they've all travelled a long way to get there apart from anything else. But clearly it's an important moment in OPEC that they're getting back together in person after 2 years. I think that a lot of ministers are keen to do that, to reconnect with their colleagues, to sit down and have one-to-one bilaterals. They haven't done this for more than 2 years. So I think we can expect a slightly longer meeting. And if they are going to discuss things other than production levels, perhaps they're going to discuss how the agreement works into next year, what people's baseline quotas are, that kind of thing, then yes, it may take a little longer. We'll see.
It's probably not what energy ministers across Europe would like to hear. Maria Tadeo, what's the latest where you are?
Listen, they have to deal with a lot here. They have to deal with an escalation in the actual war in Ukraine. They have to deal with the energy war, double-digit inflation, and of course calls now for a recession. So it is a lot. And then on top of that, Jonathan, and I really want to stress this, a number of countries also taken aback by the mega package that was announced last week by Germany, 200 billion euros. Of course, there is, to put it diplomatically, some questions around whether or not this is a problem for the level playing field in Europe. Remember, Not everyone has the fiscal capacity to deal with a crisis of this magnitude that Germany has. And to me, what this says, and this is a takeaway that I take from this, is that the countries that are pushing for this price cap on gas will now double down on this, saying, okay, you do your 200 billion euros, but then we need to cap gas prices. It's the only way everyone gets a fair deal. So this story is far from dead.
Maria, just pick up on something you said. How united are the Europeans still on this issue?
Look, the statement du jour here is that you need to stay united and show solidarity. And so far, the European Union, as you know, has approved every sanctions package unanimously. It's the only way this can get done. But there are a number of countries that behind the scenes here will tell you they were taken aback by the lack of communication from Germany. The fact that they announced a huge package, 200 billion euros, that is very difficult to match for another number of countries. And they now want to show or see from Berlin what is the political direction in the next few months. So there is a lot of pressure on the Germans to not change course, but explain themselves.
Maria Tadeo, Will Kennedy, to the two of you, thank you. Appreciate your time, as always, on the commodity market and beyond. Brent crude up by 4.93% on Brent to 89.40, on WTI up by almost 6% this morning, up by 5.9% to 84.17. So we get you some sector price action. Let's do that with Katie Greifeld. Hey, Katie.
Hey, John. Well, if you look at the sector level, you're looking at a big, broad rally. I see about 10 of 11 sectors higher today, with energy leading the way. That's, of course, in anticipation of that potential OPEC plus cut. Consumer discretionary is your sole laggard, as you can see there. That is mostly Tesla's fault. That's the biggest percent and points loser in that sector. And if we focus on autos and on oil specifically, of course, Tesla missed on those delivery forecasts. It's dragging down the likes of Rivian. It's dragging down the likes of Lucid. That is bringing down an index of U.S. automobile makers. So you did have the likes of GM turning positive. Oil, meanwhile, while America's oil and gas, it's the U.S. shale producers that are actually up a bit more than the larger multinational rivals on that potential cut. But all oil today really just screaming higher, John.
Crude getting a nice rally. Katie, thank you. Up by 5.8% on WTI, up by 4.9% on Brent. Energy equities up by 4.2% on the S&P 500. On the S&P on a benchmark, we travel higher, pushing higher by a little more than 1 full percentage point. Up next on the program, the Trading Diary from New York City. This is Bloomberg. Equities rallying this morning, 25 minutes in. Good morning to you. State of play looks like this on the S&P, advancing by 1 full percentage point. On the Nasdaq 100, up by 0.7%. Within the S&P, the sector breakdown of the rally this morning, leading the way, the energy names off the back of the rally in the commodity market, with crude popping higher off the back of the conversation about OPEC plus cuts to output, supporting crude, supporting the energy stocks this morning too. Yields are lower, I would say aggressively so. 2s, 10s and 30s. This market's all over the place. We're down 14 basis points on a 2-year. Your yield there 413.82 on a 10-year. Down about 12 basis points to 370. Through 4% last week briefly, and I think we closed last week for another weekly gain in yields for a 9th consecutive week. Will we get some kind of sustainable retreat through this week so far? On a session, we're down by 12 basis points to 370. A little bit more economic data around the corner. That's the price action. Let's get to your trading diary. On that economic data, you'll get the ISM manufacturing numbers at the top of the hour. President Biden speaking at 2:45 this afternoon. Then a busy stretch of Fed speak. New York Fed President John Williams kicking things off at 3 p.m. Eastern. Mester and Daly headlining Tuesday, followed by Bostic on Wednesday. OPEC Plus meeting in Vienna on Wednesday, and finally, looking ahead to the main event, the US payrolls report coming up on Friday from New York City. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is
30 minutes into the U.S. trading day on Monday, October 3rd. Here are the top market stories that we're following for you at this hour. UK's U-turn. The government scraps its attempts to scrap the 45% tax rate. We are live from the Tory Party conference ahead of a speech from Kwasi Kwarteng, Chancellor of the Exchequer. And panic over Credit Suisse. Stock hits new lows. Credit default swaps jump to a record after the CEO's attempts at calming investors fail. And that brings us to fears of instability. So Credit Suisse and worries over pension funds in the UK ignite fears of a financial instability problem. Markets today ignore it. S&P sees a strong relief rally. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. I definitely spent part of my weekend talking about how, talking about Credit Suisse in a 2008 kind of scenario. That was not the conversation I wanted to be having this weekend.
No, and I don't think, I have a different view of this. My view is that, and Ira Jersey is going to join us in a moment, the instability we're getting right now comes from right at the center of the financial system, and that is the Treasury market. Bond markets are all over the place, all over the place. I speak from experience standing here in the UK when I say the bond markets are all over the place. And I think that's where, if I was going to look for risk right now, I'm wondering where the unintended consequences come from there. We are getting some data. We'll talk more about this in a moment. We are getting some data, ISM manufacturing data hitting the screen right now. Recently, I would argue that US data has been better than anticipated. ISM important. 50.9, the headline number, Alex. That's down from 52.8. That is a big miss. The prices paid number comes through down by a point as well, 51.7, down from 52.5. Pretty much, though, in line with expectation. But the headline number on the manufacturing front is a miss.
And to back that up, employment and new orders now slip below 50. So new orders coming in 47.1, employment 48.7. Again, this is ahead of Jobs Friday, on Friday. So we'll get those jolts tomorrow. So maybe setting ourselves up for some little softening there in the economy, which we are expecting.
Yeah, I think at some point that is inevitable. If you start doing what the Fed is doing, you would expect the economy to slow down. That's the objective. But the data, when you take a look at the claims numbers, for instance, of late, particularly from that part of the economy, look good. The housing market's slowing down a little bit, but the labour market's been holding up. Manufacturing slowing down a little bit, but the labour market is holding up. Let's get back to our question of the day, though, which Alex has talked about, and sort of her weekend slightly different to my weekend. My weekend is dominated by, have you fixed your mortgage? Because that's the big question that everybody is asking here in the UK right now. Our question is financial stability, question mark. Do we need to worry at this point about financial instability? Well, let's kick this around a little bit. It was a question that got raised last week. The UK certainly seems to be at the epicenter of all of this, but there are other factors contributing. Mike McKee, our international economics and policy correspondent, joins us to discuss, as does our US rate strategist, Ira Jersey. Ira, I'm going to come to you, and don't be concerned about this question. But is the rates market a significant source of instability right now? We are all over the place, certainly here in the UK, and to a certain extent in the Treasury market as well. We are repricing the Fed, we are repricing QT. How unstable is this market, and do we need to worry?
Well, I think we have to worry a little bit just because liquidity is significantly worse than it has been in the recent past. And in large part, that is because of the uncertainty that you note, but there's also the inability for a lot of market makers and other potential intermediaries to take risks. So we have a market that's significantly larger than it was, a decade or even 15 years ago. And meanwhile, the funding market, so the repurchase agreement market and the other markets that kind of are the plumbing for the Treasury market, have not grown nearly as much. And in fact, if you look at the funding markets as a share of the Treasury market, they're the lowest they've ever been since the 1970s. So I think part of the reason that you see this volatility is just that you don't have smooth functioning in the Treasury market as you used to have, and the uncertainty just helps exacerbate that.
Yeah, you're JP Morgan talking about who's going to buy treasuries with the Fed not in it. People are just pulling back regardless. So Mike, I guess it brings the question in, as globally we see central banks tighten and balance sheets are going to shrink, that's going to cause a lot of problems. And we're seeing that crop up in the UK. Credit Suisse, you can argue those are idiosyncratic, but they do expose vulnerabilities in the market. How are central bankers going to look at that then?
Well, they will remember what happened in 2008, of course, and they'll keep an eye on banks like Credit Suisse and make sure that something doesn't happen that they're not anticipating, the unknown unknowns, as they say. But at this point, they feel the markets are functioning not necessarily well, but they're functioning okay. There's a couple of regulatory problems that they could deal with if they want to, and may have to fairly soon. One is the supplementary leverage ratio, which treats treasuries the same as reserves, and so banks don't want to add more treasuries to their balance sheets. They don't want to warehouse them, which gets back to the question of who's going to buy, and so there are fewer treasuries available for those repo markets. And banks also don't want a whole lot more cash at this point. So you're looking at money markets getting all this money, and they don't have anything to do with it, so they put it back to the Fed and take securities, and it's as we're talking about, and not an efficient way to run the whole thing, and there aren't enough counterparties in that market who can really make a difference. So as long as the plumbing is set up the way it is right now, there are going to be some hiccups along the way. The Fed view is kind of this will work itself out as we get through the process, but it may take some time.
Mike, the UK seems to be at the epicenter of the action right now, and we've got U-turn. We've got potentially other U-turns to follow. We don't know what's going to happen on October the 14th, when in theory the Bank of England's support for the long end of the market is going to disappear. You talk to a lot of Fed people. Two questions. One, how worried are they about this and worried about what's happening in the UK? And two, the banking system's okay, but we just exposed a weakness in the pension system that not many people had spotted. The water is going out. Is the Fed worried that it's going to spot similar problems outside of the banking system that it's going to potentially have to deal with, and deal with fast?
Well, they were very worried about what was going on in the UK last week because of the LDI situation, and they hope the Bank of England has solved that for the time being, but you just don't know what else is out there. A lot of people have used that tide going out remark of Warren Buffett's for some time. I think maybe what we might be looking at more is what kind of bodies are going to float to the surface as the floods come in, as we have all these problems. What's out there that was buried that we don't know? And that's what the Fed's going to be concerned about. They'll be on heightened alert, but given the balkanized nature of our banking supervision, it's going to take all the banking regulators to keep an eye on things to make sure that they can get ahead of any problems here like the Bank of England did.
Guys, way too many metaphors for a Monday morning. But Ira, put this all together for me then. Is it possible that we've seen then the peak in yields? As we unwind, things break, central banks have to do something different.
Yeah, so I actually think that we have seen in the long end of the Treasury curve the peak in yields, because I do think that that policy is going to be easier in the U.S. than tighter, say, in 2024. So that means the long end of the curve, doesn't necessarily have to see yields move much higher. But that doesn't mean that we won't see significant volatility, and we won't have volatility that remains, with 10, 15, 20 basis point moves in a lot of parts of the yield curve, and that's endemic in part of the uncertainty, and it's not that unusual. We got used to yields being so low that like a 3 basis point move seemed very large, right? Now that you have Treasury yields upwards of 4%, a 10 basis point move feels like a 3 basis point move used to, right? So you have to realize that it's that part of this you have to take in context of where we are in terms of the actual market.
How seriously, Ira, should we take Lael Brainard when she says that we are going to be careful not to ease policy too early? We're not going to make that same mistake again. I've just seen the Bank of England, I keep coming back to it, basically have to completely 180 on its QT policy. And I'm wondering whether or not we should really take the Fed at face value when it says it's just going to keep going and it's going to tighten to the point at which it is absolutely certain that it won't have to sort of do a do-over on raising rates.
I'm going to prop our monthly piece that we put out just this morning and just note that in February, we'll get to a real funds rate of 0. And the Federal Reserve has always hiked until the real federal funds rate was 0. And assuming that the personal consumption expenditure deflator comes down as economists forecast, we'll reach there in February. So at that point, the Fed can be on hold. Now, the challenge for the Fed then is how long do they wait, and what the economic environment in which they'll keep interest rates at that kind of 4.5%, 5% level, and for how long. And I do think that they will do that, assuming that core inflation doesn't start to roll over. But as soon as you see the unemployment rate rise and some of the things that Mike McKee will talk to you about, as soon as the economy starts to weaken significantly, that's when the Federal Reserve can start thinking about and certainly jawboning that, hey, our next move is going to be an ease, and then the market will adjust to that pretty quickly and probably ease financial conditions very fast.
All right, guys, got to leave it there. Good conversation. Set us up on Monday. Michael McKee and Ira Jersey, thank you both very much. Coming up, we're going to continue the conversation with Ellen Hazen, FL Putnam Portfolio Manager, weighing in on our question of the day, financial instability. And I just want to point out that scenario that Ira was laying out is happening on a micro level here. You've got a softer ISM manufacturing number, but you have an S&P that's up over 1.5%. The dollar drops like a stone, and yields also lower as you have some buying coming in all across the curve. Bad news? Good news. That's how the market's taking it today. This is Bloomberg.
August jobs were right on target.
Very much in line with what Wall Street expected.
A Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September jobs report, Friday on Bloomberg Television and Radio.
Markets up by 1.7%. The 2 and the 5-year fall almost 20 basis points across the curve. You're seeing a lot of buying coming in, which brings us to the question of the day. Financial instability. Joining us now, Ellen Hazen, Chief Market Strategist over at FL Putnam Investment Management. Ellen, our point was there's so many cracks that are appearing that can be quite dangerous. And are we in a moment where financial stability could be very questioned?
Thanks, Alex. We are concerned that the rise in real rates as well as nominal rates caused by central banks tightening everywhere all at once is going to expose some cracks in the financial system. However, as we look at the U.S. consumer, household balance sheets are strong. As we look at U.S. corporations, they look like they're in pretty good shape too. So it is true that years of easy money has led to leverage in unexpected places. For example, the UK pension funds levering up. Who knew? Who knew that was out there? And you are seeing some strains in some of the private equity leverage loan market and some of those deals having trouble being sold. So you are seeing some cracks. But at the end of the day, that there are not cracks at the core of the system. The core U.S. households, the core U.S. corporations look like they're in pretty good shape. So we think that the Fed is not going to blink and that they will find maintaining their credibility on inflation to be more important than easing up too early, which they know the risks that that carries.
How much damage do you think that is going to cause? Because there's a danger, and a lot of people are talking about, Ellen, that they go too far, that they do some quite significant damage. And I'm wondering how investors should prepare for that damage to be done.
I think we can expect continued volatility between now and the end of the year across asset classes, as we have seen year to date, across equities, foreign exchange, commodities, fixed income, et cetera. Chair Powell has said that there will be some pain. So we do think that that means unemployment can go up a little bit from here. But there is so much tightness in the labor market that we think it's going to be some time before the Fed decides that the pain is sufficient to warrant stopping raising rates and stopping this tightening of monetary policy.
So, Ellen, I was telling Guy that over the weekend I was talking to a friend of mine who was really worried about financial instability over at Credit Suisse and the feedback through U.S. banks, for example, asking if we were going to be in a 2008 scenario. Based on the Twittersphere blowing up over the weekend on that, I would not expect stocks to be higher. Why are we not seeing anxiety spread from Credit Suisse to elsewhere? What is that reflecting to you?
I think that says that the market currently has confidence that the U.S. banks are robust and sound. They're in so much stronger financial condition than they were back in 2008. And so we will be watching very carefully when we start seeing bank reports starting next week with JP Morgan to hear what they say, particularly about the hung loan market, right? How many write-downs are they going to have to take for those leverage loans that they can't sell? But structurally, if you look at the supplementary leverage ratio, you look at the various leverage ratios, and you look at the fact that they've really eliminated or significantly reduced a lot of their proprietary trading, they're in pretty good shape. And I think the market recognizes that, and as much as the banks didn't like all that additional regulation that they've had for the last 15 or so years, I think in this case it is proving to be the case that it engenders the confidence that was needed to prevent the banking system from having as much systemic risk.
Ellen, a lot of people don't know what's going on at the moment, and their strategy for dealing with not knowing what is going on is to go into cash. Is that the right strategy from your perspective?
Well, certainly from a personal financial planning standpoint, you always want to have some cash, okay? So market timing aside. But in terms of going into cash right now, I think that's not really that wise. You've seen equity and fixed income markets significantly negative year to date, with equity markets down double digits and even fixed income markets down single digits or double digits, depending on what market you're looking at. So going to cash now is a little bit late. I think you always want to have some cash on hand, but we would be more inclined to stay underweight equities and stay underweight fixed income with a little bit more in cash, but I wouldn't be adding to that here. In fact, quite the opposite. I think it makes sense to lean into this a little bit.
Ellen, before we let you go, there's been a lot of questions that I'm also getting about what happens in 2023 in terms of any kind of recession. Strategists seem to imply that recession could be mild and the S&P could hold up relatively well. What's your call?
We do think that recession will be mild, based primarily at this point on the strength of the household balance sheets and on the labor market. And in terms of the U.S. stock market, we've already seen declines that are commensurate with what we see with a mild recession. So if the recession is in fact mild, we've already seen the declines, and there's probably not a lot more. I think the case in which U.S. equities go down a lot more will be in a hard landing scenario where the recession is significant.
Yep. Can't rule it out yet. Ellen, great stuff. Thank you very much indeed. Ellen Hazen, Chief Market Strategist at FL Putnam Investment. Thank you very much indeed. Still ahead, steady weighing on shares today. Tesla under pressure. The car maker blaming disappointing deliveries on shipment issues. We're going to talk about whether it's supply chain or demand issues that we should be worrying about here. That's next. This is Bloomberg.
It's time for the Bloomberg Business Flash and look at some of the biggest business stories in the news right now. I'm Ruchika Gupta. Shares of Credit Suisse fell to a record low today, and the cost of insuring the bank's bonds against default climbed to a new high. The CEO had sought to calm employees and the market with a memo late Friday, stressing the bank's liquidity and capital strength. But it backfired, and investors rushed for the exit when trading opened after the weekend. Reality show star and entrepreneur Kim Kardashian will pay almost $1.3 million to settle allegations that she illegally touted a crypto security. According to the SEC, Kardashian used social media to promote a crypto asset security offered by Ethereum Max, but she failed to disclose that she was paid $250,000 to do so. And Tesla missed estimates with global deliveries in the third quarter. The electric car maker delivered almost 344,000 vehicles. That was roughly 14,000 fewer than estimates. Tesla warned that it's facing challenges in getting cars to customers, suggesting that supply chain problems are still an issue. And that is your latest Business Flash. Alex?
All right, Rika, thanks very much. Tesla stock down about 7%. Want to dig deeper now? Bloomberg's Ed Ludlow joins us now. Ed, what supply chain issues is Tesla dealing with?
Yeah, I think traditionally there's a mad sprint at the end of each quarter where it's kind of all hands on deck. The cars come out the factory and you have to move them from A to B. The difference now in this stage of Tesla's life is there are 4 factories on 3 continents, and what they've tried to do is regionalize how they handle that. And according to Elon Musk and what was in the statement, the net result was that in those final weeks of the quarter, the cars were ordered, the customers wanted them, it's just they were in transit, and you cannot book a vehicle as delivered or as revenue until the customer receives it. So below consensus was quite high. It's still a record-breaking quarter for Tesla. You know, really strong performance relative to a year ago and relative to the prior quarter.
So there is no demand issue here?
Yeah, look, across the sell side, analysts seem to be taking Tesla at face value, that this was an issue of logistics. You know, Elon Musk took to Twitter to kind of reinforce this idea that they want to get away from a situation where they are caught at the end of a quarter, trying to have this mad scramble. He talked about wanting to have more intra-quarter deliveries, have it smoother, but also flagged this idea that the expedite costs at the end of the quarter were unpalatably high. There's a data point I'd point to, Guy, which is that the production number was higher than the delivery number. They delivered around 94% of the vehicles built in the quarter, which is very low relative to recent quarters. Over the last 15 quarters or so, it has been at or above 100%. That does give further evidence that the demand is there and that this was just an issue of vehicles being in transit.
Unfair question then, why is the stock down 7%?
Recent relative strength. You know, Tesla has done well. You know, I look at its price to earnings ratio, for example. I think about the prospect of higher rates. This is a company that trades at 88 times price to earnings on a 12-month forward basis. At some point, something has to give, right? Expectations are always really high. There is some suggestion in the market this morning, this is kind of sell the news and move on. You know, we find out in earnings later this month, I think on the 29th of October, how financially they've done, and then we look to that question of demand. I think a lot of the street is saying, okay, it's one data point, but what will we find out in earnings? What will we find out actually about the December quarter as well?
Ed, Livewire, Harley spin-out electric bike company, stock on a tear.
Yeah.
Are there comparisons with Tesla, and is this basically just the customer base supporting the stock? What's the case here?
Yeah, I mean, look, there is also always some artificial trading when a company goes public via a reverse merger with a blank check company, a SPAC, right? A lot of investors do buy in prior to the start of trading, particularly the institutional investors, through a pipe. And also the market for electric motorcycles is unknown. You know, Matt Miller probably better qualified to speak about it than I, but there are not a lot of players, and the price point is interesting. You have to ask yourself, is this an expensive product relative to a gas or combustion motorcycle, and what is the demand for the product? But again, there's froth. There's always froth when a company goes public through this mechanism.
Yeah, I remember a bike designer talking to me about you can power both wheels, which makes them much more stable. Could be an interesting time. Ed, thank you very much indeed. Ed Ludlow joining us on what is happening with Tesla. Keep an eye on Livewire as well. That stock's going to be fascinating today. What have we got for you next? We're going to take you up to Birmingham. Anthony Brown, Conservative Member of Parliament and Treasury Select Committee member, joining us for the latest on the Conservative Party conference. This after a big
talking about that all day yesterday.
We're about an hour into the U.S. trading session, a serious upward trading session it is. The S&P now up a full 2 percentage points. Clearly, we were oversold. ISM also coming in weaker than expected. Bad news, good news, but still, it's a pretty strong momentum. Katie Greifeld tracking the moves. Katie?
Like you said, Alex, it's a big, broad rally today. You're looking at the S&P 500, like you said, up 2%. Interestingly, you have the NASDAQ 100, big tech, underperforming today. That's, of course, due to Tesla taking a bit of a bath from the opening bell. You've crude up in a big way, 5.5% as OPEC Plus, considering perhaps an output cut and a big rally in the bond market. You're looking at a 2-year Treasury yield down 20 basis points. And this is part of a global bond move. We're looking at the gilts here and some of the European yields, of course, falling in a big way as Liz Truss perhaps U-turns on some of those tax cut plans. A lot of that move coming in the U.S. space, though. 10-year Treasury yields also down 21 basis points. Such a big move. And if you think about where we are in the stock market, let's talk about some of the valuations here. We're going to look at the equal weight index, the forward PEs on that index. This gives a cleaner read on where valuations have fallen. And as you can see on the equal weight index, those valuations are back to about pandemic levels, still elevated relative to history, but perhaps a bargain if you're taking a look right now. That's the equal weight index. But let's go back to the energy sector because it is a big, broad rally. Really every part of the energy sector higher today, but it's the shale sector that is particularly outperforming, and it makes sense. If you have a higher oil price, that does mean higher profits.
Katie, nice. Thank you very much indeed. Katie Greifeld joining us on what's happening with these markets. Let's turn now back to the political narrative, which in certain cases is certainly driving some of that gilt volatility we've just been talking about. I want to take you up to the Conservative Party conference. It's taking place in Birmingham in the Midlands. There we find, of course, Bloomberg's Lizzie Burden. Lizzie, over to you.
Thank you, Guy. And I'm joined here at Conservative Party conference by Anthony Brown. He's a Conservative MP and member of the Treasury Select Committee. Anthony, thank you very much for joining me. I'm sure it's a busy day. After 12 years of Conservative government, is Birmingham the last hurrah?
Well, it's certainly an interesting conference. We do have a new government, obviously, in terms of a new Prime Minister, new Chancellor, new Cabinet Ministers, and they're completely focused on growth and getting the economy going again. I totally support that agenda. I supported it before they adopted it. I've written newspaper columns saying we need a laser-like focus on growth. But, you know, clearly there's been some bumps at the start, but I'm sure we can get ahead with the rest of the plan.
But before then, you supported Rishi Sunak to be the leader of the Conservative Party and the Prime Minister, and before that you were an economics journalist. Given all the turmoil we've seen in markets over the past 10 days, has it been difficult supporting these policies?
Well, as I just said, I support the focus on growth, and actually a lot of the things are, the rest of the policies, supply side policies, are really focused on getting the economy growing again. And when Rishi Sunak, and you're right, I did support him, when Rishi Sunak had announced the increase in corporation tax and also the increase in national insurance, that was before the Russian invasion of Ukraine, which sent energy prices sky high and sent inflation sky high and caused all the news of economic shocks that we're having. And I don't think any other G7 or OECD country is going into this cost of living crisis, raising taxes on companies and on individuals. So I'm very supportive of cutting that. Those are the two measures that were announced. And in fact, you can look at it another way, which is actually the Chancellor didn't say he's going to cut corporation tax. He just said he's not going to implement the increase that Rishi put in place. He did cut national insurance, but just back to the level we had in April. So we're actually in a situation that at the end of this mini budget, so-called, the taxation, those two taxes are just back at the level they were 6 months ago.
So this morning we have this massive U-turn on the cut to the top rate of income tax. In another former life, you were the leader of the British Bankers Association. If we don't hear about the cap on bankers' bonuses in Kwasi Kwarteng, the Chancellor's speech this afternoon, are we to assume that that's going to be scrapped as well?
We're talking just before his speech. I haven't seen his speech. I don't know what's in it. But the 45p tax is very different from the cap on bankers' bonuses. And one thing I would say about the cutting the 45p tax is that it would just be to the level it was throughout the last Labour government. I mean, most countries around the world have got highest rate of income tax at 40p or less. But it's clearly an issue about timing and communication. A lot of people quite understandably felt it was wrong to cut the tax on the highest earners when lots of people are really struggling to pay their energy bills, struggling to pay their food bills, and also when the government hasn't explained yet how it's going to pay for everything. So there was a lot of concern from certainly backbenchers, and the government has said it's listened. And if you ask me, do I prefer a government that listens or a government that doesn't listen, I'd say I'd much prefer a government that listens. And as the Chancellor has said, it was distraction for the rest of the plan. The 45p tax was statistically or fiscally insignificant. It was 2 billion out of 45 billion. The rest of the plan, the rest of 95% stays.
Well, exactly. You say that it was fiscally insignificant. The Chancellor, the Prime Minister, may have catered to the political worry about this being politically toxic, but what markets were offended by was that all of these other tax cuts are so much funded by borrowing and so expensive in a time of inflation when interest rates are rising. The Institute for Fiscal Studies has said that this U-turn will essentially have no effect on fiscal sustainability.
Yeah,
How can
it's only £2 billion a year. So all this is about credibility, okay? This is about the confidence that the markets have and bond traders and bondholders have in the long-term financial fiscal plan for the UK. And the problem that the Chancellor had and the government had is that they didn't do enough, and I think with the benefit of hindsight, and hindsight's a wonderful thing, they didn't do enough to reassure the markets about this. And the Prime Minister herself has said there are lessons to be learned from this. And clearly, one way to do that is publish the OBR report, which sets out how the sums add up, how the government's going to pay its way. I look forward to that. They said they're now going to publish it on November the 23rd.
Should they bring that forward?
Well, there's strong arguments to bring it forward. To be honest, I'm not inside the Treasury's thinking on that, so I don't know why they're taking 6 weeks. But certainly the chair of the Treasury Select Committee asked for it to be brought forwards. But the most important thing is to act with credibility, to really reassure the markets that you totally understand the need for sound money. And the Conservative Party is the party of sound finance, or it's nothing. We're the party that understands you've got to live within your means. And he really needs to reassure the markets that they get that, and that's what we're doing.
Well, exactly. So you say it's all about credibility, but when the Chancellor comes out and blames the market volatility again and again on international factors, dollar strength, the war in Ukraine, the Fed's actions, when our viewers have Bloomberg terminals and they can see the fluctuations in the pound and gilt tracking his announcements, doesn't that undermine this government's credibility?
Well, he's right in that there is a lot of very volatile international stuff going on. The dollar has been rising against all different currencies, not just the pound. It's risen more against the pound than others. But the pound has bounced back an awful lot. And it's
because of the U-turn today?
Well, it's now back to, I don't know the very latest data, but the last I saw is back to $1.12. But it's... clearly the war in Ukraine is causing an inflation crisis in lots of different countries. I think inflation's higher in America and Germany than it is in the UK now. So it's not a uniquely UK thing, and lots of countries, all different countries, and your readers will be aware of this, are struggling with many of the similar issues. But clearly, yes, when we came out with these measures, which weren't a surprise because they've been pre-announced, but clearly it was communicated in a way that didn't reassure the markets. And that's the lesson the government has to learn. And really emphasise that we get the message that we totally support the fact that we have to live within our means as a country.
But what our viewers can see is the Kwarteng effect, as another journalist has put it today. Even the Bank of England's chief economist Hugh Pill has said that interest rates are going to have to rise more specifically because of these fiscal measures. Do you worry that your constituents are going to not feel the benefit of the tax cuts because their mortgage costs are going to go up?
Well, mortgage costs, again, I'm not just saying this as an excuse, but it's absolutely true they are going up around the world, and interest rates around the world.
And more so because of these measures?
They went up more in the US. The latest Federal Reserve increase was 0.75%, ours was 0.5%. That was before the mini budget. And the Bank of England and the government have got different objectives. The Bank of England's objective obviously is to bring inflation down to 2%. The government objective is to restore growth. And yes, if interest rates go up more, then clearly that is bad for mortgage holders, and certainly a lot of my constituents are mortgage holders, and yes, that is very painful if you've got a big mortgage.
Bashing the Bank of England has come back to haunt the government. The Bank of England's had to ride to the rescue of the government to save the pension funds from the turmoil these policies caused in gilt markets. When Andrew Bailey comes before the Treasury Select Committee next, are you going to be giving him a Truss-style bashing?
Well, no. I mean, he came in front of us about a couple of weeks before just before the period of mourning, and we certainly sort of asked him about the prospects of the tax cuts, which we knew were coming because they were pre-announced. But in fact, the questions I asked him were about the independence of the Bank of England. We had quite a long discussion about it. So I'm a big supporter of the independence of the Bank of England, and I'm certainly reassured that the Chancellor and the Prime Minister have said they are as well. That doesn't mean you don't need to review the remit at all. The remit of the Bank of England gets reviewed on a fairly regular basis, and it was actually due for a review before the change of government. So it's not a sort of outlandish thing to say that, but it certainly should remain independent, and that's been absolutely critical for confidence in the markets, that it's an independent bank that sets interest rates. That's kept interest rates lower over the longer term than when politicians control them.
Anthony Brown, Conservative MP, member of the Treasury Select Committee, thank you very much for joining me. Now, Alex, we wait for Kwasi Kwarteng's speech. It's coming any minute now. I'm sure investors will be on the edge of their seats for every syllable.
Yep, you bet. And we'll definitely get you back in the next hour to preview that. We're looking for that to happen around 11:15 in the next hour. Lizzie, thank you very much. Great work from there. Bloomberg's Lizzie Burden joining us. All right, coming up, back to the markets here. OPEC Plus considering cutting oil output by more than 1 million barrels of oil a day when it meets in person on Wednesday for the first time in more than 2 years. Oil flying. We'll get the breakdown. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. It's a humiliating reversal for British Prime Minister Liz Truss. She now has dropped a plan to cut taxes for the UK's highest earners just 10 days after it was announced. The move was Truss's attempt to fend off a rebellion in her own Conservative Party. Chancellor of the Exchequer Kwasi Kwarteng says the tax cut plan had become a distraction. In a tweet he wrote, "We get it and we have listened." On the first day of its new term, the US Supreme Court will hear a landmark challenge to the Clean Water Act. A couple is suing the Environmental Protection Agency, hoping to limit its authority in protecting waterways and wetlands. The plaintiffs are backed by a long list of industry groups, including the National Association of Home Builders and the American Petroleum Institute. And the price of oil jumped today. There are indications that the OPEC Plus alliance may slash production by more than 1 million barrels a day to revive those plunging prices. A cutback of that size would be the biggest since the pandemic. OPEC Plus meets Wednesday in Vienna. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg, Alex.
All right, thanks so much, Ritika. Let's get more on this OPEC meeting. We are joined now by Giovanni Satchinovo, commodity analyst over at UBS. Giovanni, I'm really struggling to understand the idea of a 1 million barrel a day cut. Everything that I read talks about how inventories globally are still quite tight. What's your read on what we're going to see on Wednesday?
So we're expecting that OPEC will cut at least 500,000 barrels per day, and essentially you're right, the market is tight. Inventories on the OECD side stand at the multi-year low. That's commercial and government-controlled inventories, and what we have seen is that the oil prices, despite of that fact, fallen. Strong dollar, risk aversion, and investors leaving the oil market, and essentially the OPEC cut aims to stop this negative momentum in the market and help stabilize prices and eventually turn the direction of prices.
Giovanni, how big would the cut have to be a real cut?
We need to make a clear distinction here. One is if it's applied from the production cap level that at the moment are valid, the effective cut would be only a fraction of the real cut. Essentially, OPEC plus countries are producing more than 3 million barrels per day below the production cut level. So essentially, let's say they make a 1 million barrels per day cut, the effective cut would be just a third out of it, eventually a little bit more, primarily of with Saudi Arabia taking the biggest share. And essentially, if we get voluntary extra cuts, then the effect would be much stronger on the price side.
So, Giovanni, go ahead, you guys.
Sorry, Alex. No. I just want, is anything less than a 3 million barrel a day cut a cut? Because basically that would seem to imply that you're just having, you're just realizing what the reality of the current production situation is.
Any cut would be a cut, but it would be only a fraction of the paper cut. So effectively, it's still, if we do only 500,000, there will be a small cut. But to have a bigger impact on stabilized markets, essentially voluntary cuts of country producing close to the cap level would have a stronger impact on prices. So if Saudi Arabia comes in and says we do additionally 500,000, that would remove a larger quantity of barrels from the market.
It feels though what Guy's trying to get at is Russia and how Russia is not actually producing the quota that they're allowed to. They're nowhere near that 11 million barrels of oil that they're allowed to, right? So in essence, wouldn't a cut just be making up for oil that's not even on the market?
That's probably a reason why Russia is in favor of the production cut. So if the latest data shows their production at 9.8 million barrels per day, as you said, their quota is at 11 million. So whatever cut is agreed on, they don't have to make any cuts. So it helps them to stabilize market and see higher prices eventually if the other take down their production.
Giovanni, is the return to in-person meetings significant? And do you think Novak will be there?
I don't know if the Russian Deputy Prime Minister will be present at the meeting. We will figure it out later this week. But essentially, by meeting in person, it's clear that the cut is not a small one, and some surprises can still be expected. We know out of the past that the Saudi Energy Minister likes to surprise markets. So let's see what he takes out of his magician head, which rabbit, and how he surprises the markets.
Which then brings us back to the original point, which was this is just really to get investors back back into the market, isn't it? I mean, what kind of level of backwardation do you think we're going to see where the price right now is much higher than the price in the future to entice investors back to the market, to calm the price action so investors come back to the market?
So essentially what we have seen is that the oil market remained constantly in backwardation, and this is normally positive for oil investors. Even if the price stays stable, investors benefit from a positive roll returns. That backwardation has weakened down a bit in recent weeks, and this is partially offset by higher US interest rates. But essentially, if OPEC managed to take out of barrels from the market, and the competition from non-OPEC countries outside of the alliance is not strong, so US production is not growing strongly, and they can keep the market in backwardation, and that should help also investors come back into the market.
Well, also though, it seems like what they need to do is calm volatility. It's not just the level of backwardation, although I hear you on the roll, but in terms of volatility, when you have these enormous swings, investors are going to go somewhere else to get more stability. Do you think that Saudi Arabia, which, let's be honest, it's really down to Saudi Arabia, has the ability to really calm that window?
Essentially, it's a difficult market because there are so many moving parts. Demand concern on the one hand, recession fears. We don't know how the COVID policy in China will be next year. We just have some clarity about the supply side, that non-OPEC countries will grow at a small amount, but at the same time there are risk of supply disruption happening, so volatility likely will stay elevated as we have seen in the past. Hopefully OPEC managed to bring down a little bit volatility over the coming weeks.
Giovanni, when you think about volatility, how are you thinking about and factoring in the dollar? The dollar is a huge sort of component part of the energy trade, the commodities trade. The bond market is swinging wildly right now. We've got a big move in the dollar again today. How big a source of volatility is that going to be for the energy market as you think about what the story is going to look like over the next 6 months?
If we look historically, the correlation between the dollar and the oil price has been negative, but to a marginal fraction, and that correlation has been far from stable. There has been periods where the correlation even flipped into positive, driven by supply disruptions. In my view, at the moment, it's a combination of aggressive monetary policy tightening, supporting the dollar, but at the same time triggering demand concern in the oil market, resulting in that negative correlation that we see at the moment in the market. Obviously also the strong dollar means that a lot of consumers don't benefit from the price decline we have seen in recent weeks. But essentially, if we get this supply disruption with the ban from the European Union Russian oil coming into force on December 5, we can see also that correlation breaking down in my view.
All right, one quick question then, Giovanni. What's the range that the Saudis are going to want to see oil? 80 to 100? What is it?
Officially, the statement out of OPEC is always we don't control prices, sure. But I guess they prefer to see oil prices above $90 level for Brent. Eventually, even 100 they are probably not unhappy to see.
Giovanni, great to catch up. Thanks for the insight. We really appreciate it. Giovanni Stanovo of UBS out of Zurich. Thank you very much indeed. This is Bloomberg. We're approaching the European close. Let's talk about what's happening on our side of the pond right now. Brent crude, you've just been talking about it. We're up by nearly 4%. We're at 88.47 right now. Stocks seem to be up on that bad ISM manufacturing number out of the States. Is bad news really good news for stocks? We'll talk about that in a moment. And then we've got the volatility that's coming out of the bond market. We've got a 3.929 handle on a UK 10-year. We're down by 16 basis points. The 2-year moving aggressively. You're getting real swings in the risk-free rates around the world. And this is what I think is unnerving a whole load of people. Clearly, we're going to be watching to see what Kwasi Kwarteng, the Chancellor, says in the next hour. We have his big speech coming up from Birmingham at around 4:15 UK time, 11:15 over in the United States. We'll bring you that speech. We've already seen one U-turn. Is he going to hint at more? The bond market very much on tenterhooks to see what is happening. The pound's had a relatively good day as well. But we're trying to figure out this financial stability question right now. The Fed, other central banks moving very aggressively at the moment, and they say that they're going to continue to do so. Is that going to cause problems in the same way that we've seen here in the UK? Are we going to see those problems elsewhere? Is financial instability going to mean that we are going to see pivots? We'll try and bring it all together for you in the next hour as we count you down to the close. Seema Shah, Chief Strategist of Principal Global Investors, is going to be joining us. We'll get her take on what is happening here. That's next. This is Bloomberg. Monday the 3rd of October, European stocks are up. Great start to the quarter. Oil's up. You've got the bond market up as well. What's given? The dollar is down. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So, great way to start the quarter. Look at that screen. You've got a lot of green there. The question is it symbolic of good things, or actually is it symbolic of actually concern starting to come into the economy and key stocks? We'll talk about some of the key stocks here in Europe and the worry surrounding them. Stock markets are higher. We had an ISM number, manufacturing, at the top of the last hour that wasn't good. Bad news seems to be taken as good news because it's going to impact the Fed and the Fed pivot. Stocks are higher. Brent crude up by 3.44%. That's an OPEC story. The real turbulence, I think, and this is where the concern lies at the moment, the big swings, Alex, that we're getting in bond markets, particularly UK bond markets. Today we're bid. We're about to hear from the Chancellor. Will we continue to be bid? We'll wait and see.
Well, we'll give you a run for our money over here. We get the 2-year yield up down by 21 basis points. So with the action. So a couple things happening in U.S. markets. One, you had the end of the quarter, right? So you're having some relief buying come in. We were also so oversold. So seeing a bounce today is no surprise. Then you get the headlines from OPEC Plus that they could be cutting 1 million barrels of oil a day, meeting in person on Wednesday, and that helps support oil. So all of that coming into the market, and the S&P is up a whopping 2%, and energy up almost 5%. Now, the other indicator happened on the eco front. That was ISM manufacturing coming out just at the top of the last hour. It was soft. You also had employment and price and new orders rolling over. New orders now down by 3 in the last 4 reads. That means, okay, we're seeing economy slowing. It's not terrible yet, but maybe the Fed's going to have to slow its roll a little bit. We are now almost pricing in a rate cut for November of next year from the Fed. So all of those stories coming in to see a better equity market and lower yields, Guy.
Alex, let's talk about some of the single stocks that are causing turbulence over here in Europe. We've got the macro story, but we've also got the granular bottom-up story to factor in as well. Credit Suisse, more turbulence, fresh market turmoil. Friday, we get the CEO, the new CEO, coming out, trying to attempt to reassure investors and to a certain extent investors. Don't look at the share price. Worry, think more about what is happening from a sort of stability point of view. That is where our strength ultimately lies. But it backfired. The market, investors, employees didn't necessarily read it that way. But actually, did he have a point? And I think that's the question I think we need to step back and think about here. Sonali Basak joins us to try and assess what is happening here. Communication is key at these critical junctures, Sonali. Was that just bad communication, or is this a bad story underlying what we're watching here?
It's a good question, because for Credit Suisse, we know that these issues have existed, and not only existed, but exacerbating, because you're seeing them in this vicious cycle of rising funding costs as well as deteriorating revenue. The question of whether a capital raise looms near and how they really fill that gap with asset sales is still a big question. But let's talk real quickly, as you say, about what happened over the weekend, because you saw the stock fall to a record low. You are seeing ADRs now rising in the U.S. session as some of these fears are being assuaded. But I think also you look at what Boaz Weinstein just said about an hour ago on Twitter. He says the European bank sub-CDS is a good catch-all tail hedge for the myriad of problems swirling around. So you have Credit Suisse caught up in this grand macro story now, which puts it in a really difficult and interesting position compared to where you saw, for example, Deutsche Bank in 2016, where the market was really freaked out about the CDS widening and what would happen to the bank in the longer term. Now, I did ask another investor another issue. I said, you know, are you really worried? This is a longtime banking investor, about whether he's worried about Credit Suisse in the long term. What he told me is no, and I said, is that because they're a diamond of Switzerland, or because you think that they can operationally turn around this story? And he said it's the former, not the latter. They are a diamond of Switzerland. This is a massive bank, one of, you know, two, as we always talk about, that Switzerland is really worried about, that since after 2008, of course, the regulators have kept a close eye. This is not a bank that is made to fail for Switzerland. So again, their capital buffers, as the CEO was saying, the point, Guy, that you say that he is really hitting home here is they're not in this liquidity crunch now at all. And in fact, their capital ratios are in their planned range for the year. And as Marian Halftermeyer of Bloomberg points out as well, those capital ratios are actually higher than where Deutsche Bank had them back in 2016, where we saw that really big market issue.
And that was that's a really good point. And I also think that the whole idea of the too big to fail is real. They don't want a repeat of Lehman and all that. Nonetheless, where is the counterparty risk? Like, if something Credit Suisse may be around no problem, but there may be a lot of turmoil in the meantime. Where is the contagion risk for that?
That's a great question because you have clients on multiple sides of the equation here. And if you look at any trading client, for example, we know that many trading clients since Archegos have started to diversify their base here. They've started to move to banks with higher credit ratings, American banks, and we've seen that even float through for many, many quarters now in the trading numbers. The investment bank, which is under a big strategic question today, I think that's also interesting to see whether clients will stay or go based on worries about larger systemic issues down the road. But listen, just for Credit Suisse alone, what happens now is we already knew this would be a long turnaround story. The costs they'll have to face in the near term will make it an even longer turnaround story. And the quote that really struck me in the memo to clients, everyone was focused on the liquidity and the critical moment. The part that struck me is the metaphor the CEO uses, is that Credit Suisse is looking to rise like a phoenix. That's from the ashes. And so you're looking at the CEO acknowledging to his employees that this is not an easy task by any means, but it's something he's trying to rally the troops around and is asking them to get along for the ride.
Yeah, I don't know how much you want to compare yourself to ashes on that. Bloomberg, Sonali Basak, thank you very much. I really appreciate it. Sonali joining us there. So that is a great setup to our question of the day, which is financial stability? Question mark. Are we seeing this as central banks continue to tighten globally around the world? Are we seeing the fallout from that? Seema Shah, Principal Global Advisors Chief Strategist, joins us now. Seema, is this the beginning of that big snowball rolling down a hill?
Hi, Alex. I don't know. I think it's a tough one to call this a snowball effect. What I think we are